Okay, good afternoon, guys. Might as well get started. But just a minute to go. There's some Canadian data out, housing data coming out now. Don't really think it's going to affect the markets too much, but obviously always have to be aware of the fundamentals. So another live trading clinic today. My name's Steve Ruffley. You should know by now. Going to focus on gold today. Obviously, there's been a lot in the press about gold. There's certainly a lot of trading opportunities. It's quite a violent market right now. So we'll go through some kind of indication of what I think is going to happen, longer term, short term, pick out some trading opportunities. So before I start, let's just do a quick slideshow. The risk warning, remember that spread betting and CFD trading both carry a high level of risk or capital, resulting in losses that exceed your initial deposit. It may be suitable for everyone, so please ensure you fully understand the risks involved. The information provided here under no circumstances considered an offer to safe to invest. Nothing here should reduce investment advice. Information provided is believed to be accurate and data is produced. Again, educational only. Content of the webinar is personal opinion of the moderation on Intrade.com. Content is not constitute financial investment or tax advice. Intrade.com is not accept any liability of the content of comments made during this session. So we're going to go over live charting analysis. I'll go over my charts as always, levels, any kind of indicators. And once we've spoke about gold, we can talk about anything you want. Again, these are always open sessions, so type through in the Q&A or chat window exactly what you want to go through. If you're struggling with any levels or anything, then just let me know. Before this, I was trading initial jobless, so took a little bit of a short position on the S&P with worse than expected jobless claims. Markets have decided to spike up, so that's fine. We got out of that trade for a manageable loss. These things happen. Retail sales was a little bit better than expected, but not anything major, to be honest. So I was expecting with jobless above the range that the markets might have tested lower before rebounding. But just goes to show that the harder things move down, the more they want to rebound back. So with 250, 60 points lost in the S&P yesterday, is certainly entitled to pop back up and for people to take some profit. Multiple time frame trading. I'll go through different time frames and show you how I build up my picture of the markets. Fundamental analysis, again, lots to speak about in the markets. Quantitative easing is really the main one. Will they, won't they? Well, obviously, will they? Yes, but when will they? That's the main question. Will it be January or will it be March? If there's anything good, got my account open, so I'll put any live trades on. And again, these things will work out, you guys. So question and answers, anything you want to ask me, just type them through on the chat window. There's no right or wrong questions here. We're all here to give our opinions together. So let me know. So we start with the monthlies, okay? So monthly looks a little bit messy, but I think I'll show you some simple techniques that, make you understand what the market's doing long term. So this is a monthly chart, so we can obviously say this is a very bullish move. So if you're going to do a Fibonacci retracement, obviously the market now is moving down. You can either start it from here, where maybe April 2005, where the real up move started, or again, this is quite a nice area here, okay, down at 693, where the market's really tested up, tested back down, and then the move started. So let's do from the start of the green candle here, where we think the market information is telling us. Okay, so on the monthlies, really we've hit the highs up at 1920, and speaking to different people, different market economists, there's two schools of thought. It's either going to continue back to $2,000, or my prediction is going to hit $1,000 by 2015. So I've been quoted the FT saying that, and I think that's probably the likely bet. But what you can see is the market's move in relatively, even though this is longer term, relatively, kind of the standard points where we don't kind of look back. So okay, once we've kind of hit the double top here at 290, gold really then found good solid resistance at 1795. Okay, and then after that, it's hit the 23.6. Again, that's become support resistance. Hit the 38.2, the 50%, which is the key level. Again, we aggressively break through this month, but come back. We don't then test the 38.2. The 50% becomes support again, but now we're breaking through. So now we've closed significantly below the 50% in the monthly. Really, your target is a 1180. Okay, and then below 1180, all this congestion here between 988 and 1044. Below that, 864. Okay, so realistically, quite a lot of downward movement on the monthly charts. A good 2,500 ticks, you would say. So on the weeklies, you start to zoom in, and this is the multiple time frame, kind of view. This is the week, so we get a bit more information, a bit more kind of, understanding of what is really kind of happening now. So we can see that the markets really have, again, that 50%, you know, found good weekly support, but it's been an area of interest. So that now that's rejected and the market's decided it wants to move down, then realistically, you know, the next point we're looking to touch is down here at 1180. So, you know, this is certainly where the market is, you know, is looking to kind of get down to for me, you know, personally. It wants to kind of test here. So, again, if you want to zoom in, you look at the dailies. Same, you know, it's the same information. You have to understand when you're looking at charts. You know, a monthly, you know, candle is made up of, you know, weekly data. It's made up of daily data, made up of hourly data. You're just seeing a bigger picture. So when you see the bigger picture, you start to zoom in to focus on what the actual trades are and what you're trying to achieve. So for me, again, this double top here, or this kind of single top here, and this reversal pattern on the dailies is a good indication. We've seen nothing but up movement, okay? Consistently making higher lows, higher highs. We see this particular pattern, which is, you know, a standard candlestick on the dailies, you know, a kind of shooting star, or I guess you call this a hammer because it's on the way down to the top of an uptrend. That indicates that we're ready for a downward. Then really from there, the market acts in quite a structured way. You know, it moves between the support and resistance lines we have, but also follows the Bollinger Bands down. Okay, and this is really, you know, what we're trying to do. You know, understand what the market's doing, and then, you know, let it flow. You know, let it kind of go with us. You know, and pick the tops, and then follow them down to the moving average, follow them down to the low end. You know, of the kind of areas of you know, kind of support. And then, again, when you're doing trending markets, you have to be very aware that these levels, again, although they look like the extremes, you know, you have to be aware that levels can both break and bounce. So what you're trying really to do, you know, is let the markets, you know, work with you. You know, again, break and bounce, that's, you know, that's what we're looking to do. You know, we're looking to, you know, break, bounce, you know, and start to move in the right kind of direction and let the markets, you know, help us. You know, it's always difficult to kind of, you know, explain, you know, how the markets move. And it's really just looking for value. So you don't want to be looking for value all the time in one direction. You know, markets move, you know, along all different kind of, you know, different ways. You know, they'll let you move between support, they'll let you move between resistance, and everyone's finding value, you know, at different stages, at different points. So short-term buyers might get involved in one price, but longer-term sellers, you know, might be looking at that as another opportunity. So you always got people getting in and getting out of trades. You know, that's what's important to kind of to understand, that, you know, that the markets, you know, because, you know, they're not just for the second you're in a trade, the minute you're in a trade, the hour you're in a trade. You know, these things are always longer-term. You know, you're looking for what other people, other market participants are going to be doing. And you can't always necessarily just get involved in the market at one price and think there's nothing else being involved, okay? So for me, gold right now, if you're looking on the dailies, it still looks like it's got some downward kind of value for me. You know, 1, 2, 2, 6, 3, 7, I guess, is the next kind of logical place a daily low would look to hit. So I always look at the hourly candles, because for me that's really the kind of the best way of understanding this. So if you look at the hourly candles, obviously we've seen this big sell-off, and we've seen the market kind of, you know, a lot of red candles. So where would be the next opportunity? Well, again, you could look at it in two ways. You could look at the next buying opportunity might be 1, 2, 2, 6, 3, 7, or maybe on the market then overextend, as gold tends to do. And we look at this again, you know, this big spike down and break through the Bollinger Band. You know, gold acts like any other tradable product. You know, we don't always, you know, kind of, you know, just hit the lows and continue to go down. You know, the market will always find value in different places. So again, right now, it looks like gold is certainly, you know, on a downward trend, but, you know, everybody or other market participants, longer term traders, you know, might see good levels, you know, to kind of buy back down, you know, these levels and let the market push back up. So hourly is really right now for me. Again, these are the same lines. So all the lines you see are from the monthly chart, the weekly chart, the daily chart. Okay, so they're all exactly the same. But what you're looking to do is see how they work for you on a manageable time frame. And hourly, for me, you know, is a manageable time frame. What we're trying to do is pick out them short-term opportunities and you know, make a trade out of it. So right now we've seen 1, 2, 3 red candles. So even if you were to do a Fibonacci, you know, if you call that the low, you know, the market really hasn't kind of rebounded at all. The 50% again has acted as a down buffer to push the market down. So again, that might be something we want to look at. That realistically, the market, it's kind of like it's failing to do what we want it to do. It's not rebounding up. It's not going back into the range. What it's trying to do, is push lower and to get all the kind of longer term, long buyers, the people with different kind of opinions on gold out of the market and squeeze them further down. So gold again, it starts to make the lows here. It hasn't really got far to drop between that 1, 2, 3, 6, 3, 7. So realistically, maybe that's a good point in which the market's going to look to test before, somebody takes a different opinion. Because you have to remember, it doesn't matter what it is, if it's gold, silver, oil, everyone finds value in different ways. So you have to realistically understand, what the time frames we're looking at, what the main kind of emphasis is, and what really, people are trying to achieve. So as a day trader, an intraday trader, what you're trying to do is figure out them small, short-term blips, being able just to jump in and out of the market and take that volatility out. And that's really all a short-term trader is ever trying to achieve, just get involved in the markets and, take advantage of what other people are trying to achieve longer term. So, obviously, if you want to be a day trader, that's, its very kind of name is different implications. But if you want to be, a longer term trader, then you have to be in for the long haul. To be a long term investor or trader, you have to be able to hold overnight positions. Okay, so not many people, really kind of, prepared to do that. And if you don't want to hold overnight positions, then really, you're just that. You're a short term trader. You're a scalper. All you're trying to do is kind of get involved in the the short term movement. And try and try and take advantage of that volatility. And again, it's very, very difficult because many times we can open up our charts and say, well, I think the market's going to go down today, so that's fine. But just because you get right the daily direction or that kind of particular movement doesn't mean you're going to make money out of it. And I think that for me is definitely the hardest part of trading is being able to pick out direction, pick out what the market's telling you, and then make some money. I think gold really has demonstrated that if you pick the highs of gold, all you had to do was, sit on it, and it was obviously going to go down in value to some extent. Well, that's how people made the money, by buying gold and sitting on it. Okay? So, again, gold, I still think there's a little bit downward movement in the short term. But what I would say is that definitely, we have to kind of think of, the bigger term kind of picture. Gold has obviously dropped significantly this year, so a lot of people will be readjusting positions or will be getting out of longer term positions. But will that mean that the rest of the market will come back and again find some intrinsic value in gold? I think what you have to remember is there's no shortage of gold. There never has been. Okay, gold is purely where it is through speculation. There's no physical supply of gold. If anything, there's more gold in the world now than there's ever been in the world, because everybody's cashed in, the cash for gold, etc., etc. Everybody has got involved in the market and gone. So we're touching the lows now in gold now. So if it breaks through, you have to think that, what's going to drive the market lower now? Is it going to drive it lower through people selling? Because again, it looks like, the market is due to come back. Probably Fibonacci from here, from the low to the high. So we've really kind of, again, closed on the 50%. So this level here, 1226, is looking even more, increasingly likely it's going to be hit. But it's not a million miles away. Realistically, we're kind of 52 ticks. And we can see that gold, the aggressive nature that it moves can certainly, move that distance in 1 hourly candle. It can certainly do that in a 5-minute candle. So, but you have to look how it gets. So, red candle, small consolidation, 1, 2, 3, 4. Generally, you see the fourth candle, or it's generally the third or fourth candle that holds the most, kind of direction and volatility, because that's everybody waiting for confirmation that it's closed outside the Bollinger Band, closed outside the Bollinger Band, closed outside the Bollinger Band. Okay, well, it has to then make some lows. So realistically for me, we got down to 1, 2, 2, 6, 3, 7, in a quick kind of spike. I'd probably buy it for a bit of a retracement, because again, we've closed so many times outside the Bollinger Band. We know we can only do that for a certain amount of time before we hit back. And where we're going to hit back to? The 50%. And obviously, the moving average. So it's trying to tie up all them longer-term directional thoughts, them longer-term kind of indications of what the longer-term trade is doing, and then try and pick the old moment out. I mean, what do you think, guys? I mean, we've got some regulars here. We've got Chris, we've got Jamie, we've got Pan on Fire. What do you think for gold? I mean, again, what you should really say is, all right, Steve, when we started talking, we were talking that, gold was going to hit 122,637. So why don't you sell gold until that point? It's difficult. I mean, we're all trading our own different ways. I mean, gold, it's coming down, it's selling. I mean, since we've been talking, it's dropped 45 ticks. But realistically for me, it's how it gets there. I would like to have been short round about the moving average or here, and then you hold on for the long trade. Getting involved now, all you're doing is selling the low and, expecting to get back in the pullbacks. You pretty much sell now and instantly go offside. So what I'm looking for is an overextension, market to really, really hit lower. And if it, comes down like it is doing now, I'm going to get ready to buy gold, okay? So if it hits down here, in this hourly candle, we're only 15 minutes on. If it hits that pretty quickly, then I'm going to buy some gold as a spike. Okay, Forex Girl saying, believe it will go up if bad news will linger a while, but eventually along will it will drop. Yeah, I mean, I can live with that synopsis. I think that's exactly right. I'm exactly the same feeling that the more fear in the market, obviously gold is a safe haven. Speculators will drive it up, but realistically, gold, there is no shortage of it. There's more gold in the world than there ever has been. So from a kind of supply and demand perspective, it's not oil. It's not something we rely on for our, daily lives. Oil is involved in everything we do, and it's very, very important. It powers the world, and they're not making any more oil. So that, for me, will always be on an uptrend. It's a scarce commodity that will always be of value to people. Whereas gold, all right, it's used in manufacturing, but generally it's just trinkets. Okay, it's used for people's enjoyment. It's not central, and it's not, you're not going to change the way, if gold didn't, exist tomorrow, then we're not going to cry about it, are we? We're not going to kind of say, oh, well, I can't wear the gold, necklace anymore. It's not really going to affect the way we live. So for that very reason itself, it's fundamentally flawed. But it's not, we don't rely on it in our daily lives. So why, again, should gold be such highly priced? And that goes back to, to the speculation argument. That basically it's just been driven up by speculators, hedge funds, people with money that, they're worried about losing, and gold was the place to put it. But as soon as that starts to come down in value, people cash out, and then people take the opposite direction. So it's as simple as that. People aren't going to start jumping into gold anymore and heavily buying it, because why would they? Why would they? Once the speculation money's out of it, then, there is no room for gold. So the S&P is starting to drop off now. The majority of the markets are kind of retracing them early gains. One of them things, again, as I said, I was short the kind of S&P after that data, and the market's blipped up. So we just took a call to get out. There's absolutely no point in taking, a short-term trade into a longer-term trade. Again, these things always happen. I mean, what else do you want to look at, guys? I mean, gold, again, it depends. In this next hourly candle, as I say, that looks like it's bearish enough for me to do a short-term buy. But I wouldn't hold the trade for particularly long. I'd just try and catch that bottom of the move. Yeah, absolutely, Pan of Fire. I mean, everything's been very choppy. The markets have been particularly difficult to trade over the last few weeks and months. And again, it's down to the fundamentals. It's down to, again, people taking a better than non-farm payroll that they expected. Everyone was anticipating that a good non-farm payroll would, make the market sell off, but it didn't. It made the market spike up. And then a few days later, when the market absorbed the data, we sold off. So again, it's one of these things, guys, isn't it? It's kind of markets now got going, red across the board. The S&P now is negative. Where we go. It's all very, very difficult. So Forex Gal saying, hope the Fed tapers some next week, and maybe the markets will start to act naturally. I mean, that's a very, very good, valid comment. Absolutely, Forex Gal. I mean, the whole point is we don't know how the markets are acting because they are artificial. Basically, any dip we've seen in the stock markets over the last couple of years, you were safe to buy them because it was free money essentially. All you were doing, was betting on that no matter how bad the data was, the Fed would step in and sort the situation out. So markets were not acting naturally because there's always that safety net, thinking that if anything bad happened, that the Fed had come in to save the day, and that's exactly what they did. So when the Fed do taper, and that isn't in the markets anymore, well, what will happen when we start to hit these lows? And the markets will probably aggressively, try to correct. What Chris is just saying, I think at some point the money backs with intrinsic value, something's probably going to be gold, currency like to be the yuan. Yeah, the dollar, dollar yen, dollar, the yuan, etc., is, quite a contentious point. You have to think that although, people are trading gold, that's still priced in dollars. So, the dollar is still the world currency. So you have to think about who holds reserves in dollars, and whose interest it is for the dollar to be at a certain price. So all these things are intrinsically linked. Just because gold is it's been on a massive bull run and then, seems to turn the reverse and be on a bear run, doesn't mean it's going to continue forever. The whole point about when, I was back at the days when I worked for PricewaterhouseCoopers, all we talked about was having a balanced portfolio. So being able to balance, risk versus reward, different asset classes and different things against each other. And that's all trading is. So some portfolio to any extreme will hold bonds, it will hold stocks, and it will hold some sort of precious metal, because that's just how you balance things out. But, you've got to keep your view on board that, remember that just because something, is in vogue, is in trend now, doesn't mean it's going to be in trend later on. Can we look at the Dow? It's breaking the long-term channel. Yep. The dollar sucks. Yeah, okay, I'm with that. Let's look at the Dow. 1 second. Okay, so we've got the Dow, we've got the S&P. So the S&P has just basically started to trade back to where it was before the data. So again, just retraced all that initial spike up. The Dow, again, if you look at the longer term kind of, RSI and the hourly, we're starting to, that was a real kind of big fake out. I should have really kind of stayed short in that trade, but, what can you do? You can't win them all. But, again, we saw that spike up from the D-Mark. We saw that spike up from the RSI, trying to push it to the 50. Then we're already back down. So big trends coming up. 177.425 is where I expect the S&P to test today, and then potentially break lower. The Dow, again, has got 15784. Again, it's just the same as the S&P. So we see another big. Look at the daily charts. It says it all. Okay, so the market basically has rejected the highs up here, and that's the level to talk. So we've moved all that distance yesterday. There's nothing to stop the Dow hitting the low here at 15784, and then hitting down to 156. That's 130 ticks. The Dow can do that in a couple of hours. So it's just to understand. Look, looks a bit more aggressive, the Dow, than the S&P. The S&P again is pushed up, so that could fall down a lot more aggressively than the Dow. We're below the 50 mark in the Dow RSI. We're coming towards the oversold territory. The demarcation indicators at 0.3644. So again, it's likely we're going to see a breakdown. The trend has been that we've seen aggressive selling, but you just don't know, guys. Look, on the dailies, we're towards the low end of the Bollinger Band, so don't be surprised if we can't push aggressively through these lower levels. If the market doesn't break back up and try and hit higher. So, what else are people saying? The Aussie dollar. People always ask me about the Aussie dollar. Bottom now. The whole point is, if it keeps breaking the lows, then you have to be prepared to sell the highs. Why try and pick bottoms? There's an old saying in trading. Okay, you pick bottoms, you get smelly fingers. Trading's fear. So if people keep seeing them lows and say, oh, that has to be the bottom of the market. No, it doesn't. Why does it have to be the bottom of the market? When I told you, when you look at these levels, you're looking for them to do one of two things, break or bounce. When markets are strongly trending in any direction, the targets for the market to break. Okay? So you don't want to be buying them bottom levels. You want to be anticipating that the market's going to hit these lower levels and break through them. Okay? Bob, break or bounce. So has the Aussie dollar reached a low? No, it hasn't. It'll reach the low when it's reached the low, and it'll reach the low while everybody who's ever longed it has got so burnt that they couldn't possibly buy it, even if it was free. And then it goes up. Okay, that's just the way the markets work. So I would say no, it hasn't bottomed. Yeah, weakening dollar. Yeah, I mean, again, there's two schools of thought. So the dollar's either going to, rapidly appreciate or rapidly depreciate, depending on how you look at it, after the quantitative easing. I mean, the whole point is that the US is still a manufacturing nation. It heavily relies on that. So it's in its favour to have a competitive dollar. But then remember, you've got places like Japan, which are much more reliant on their exports and much more keen to have a devalued currency. And they hold more dollars than the US, by 100-fold. I think, the dollar reserves in Japan currently top 4 trillion. We know the deficit in the US is, the biggest it's ever been. So if the currency markets want to, have a battle and you want to see what's going to happen to the dollar, it won't be us traders that dictate it. It'll be central banks that dictate where the dollar's going to be. But you have to take, a view on the longer term. Is quantitative easing, when it does come in, is it actually good news? Okay? We know we can't keep propping up the economy forever. We know that it's, we know that it's a false economy. But again, we also know that the US is still the biggest nation on earth, in terms of GDP and spend per capita. So if it wants to kind of say, yes, we're going to stop quantitative easing tomorrow, and then the next day say, well, actually, we're not. We're going to carry it on. There's nothing we can do, is there? So it's just how we kind of, get involved in that. So Chris, is saying hold that goal. And Forrest Gall, manipulated global economy. Yeah, but the thing is, we know about these things, so it can be manipulated, but at least we know the rules of the game. Okay, so if that's the game, that's the game. It doesn't make any difference. As long as we understand the rules of the game, we can get involved. So for me, yes, it's manipulated, and it's, again, controlled by central governments, it's controlled by policymakers, but it doesn't matter. We're all aware that quantitative easing is still in the markets. Okay, so here we go. Gold could be hitting that 122637 at any minute now. So that, for me, I think would be a strong buy. Again, we moved quite a way down. So, like I say, it's kind of a double bottom for me. So again, the bigger these levels, the more they are, tending to break. So we're going to take a short-term trade. We're going to make sure we don't stay in it particularly long. But I still think, personally, that would be a good level to buy at. So again, we're kind of demarked mid-range, RSI, slightly, again. So let's see. That's quite a big hourly candle. So as I said, you could have just sold gold and made 50, 60 ticks out of that. But again, that's not kind of the way I trade. Right now, I'm kind of looking for these big overextended movements and trying to, to pick out these, these bottoms right now. So only really kind of, a short distance away from that. Again, what I would like to say with gold is that because it is so directional, it moves so quick, you generally like the markets to move very, very quickly. So I like to see when they jump down. When they jump down, they gap out prices, because that's when people are getting out and people are going to, kind of reverse the position and, kind of turn and burn. So again, it's also a place for profit taking. So the quicker it gets there, the quicker people, change that opinion and are going to get out. So right now, we're kind of teetering on the load of gold. We know, again, 1226 will be a natural place for people to get out. And also for people like me that are thinking, that's where it might be a good buying opportunity. But, we could quite easily break through that and get down to 121764. So again, it's a bit of a judgment call, really, on your part. It's how you think the market's got down there and how you think it's going to react when it is. So, again, like I said, it's always difficult, isn't it? When you've got a good idea where the market's going to go, you should always kind of go with the market direction, trying to make money, like I said, trying to short it rather than buying it and picking bottoms, because we know, that can lead to, to losing trades. But, again, I think when we're all trading the markets, we're all looking for that nirvana. We're all looking for that perfect trade and, to pick the extremes of the market and and to get, that point where you've picked the very best price in the market. But it's very difficult, isn't it? It's very difficult to kind of tell people how you interpret the markets, how you evaluate risk, how you evaluate reward, essentially what you're trying to achieve. And I think what you have to understand is that we're all so different in how we view the market. So we're all trying to achieve the same kind of objectives, and that's just to generally make money. We have to understand as well that we can all do it in different ways. Some people are very, very risk averse, very cautious. Some people are quite aggressive. Yeah, I mean, Forrest Gale saying that's why options don't interest you. You have to predict the tops and bottoms. Yeah, I mean, again, it's another financial instrument that gives people different, different options within the market. You have to think that people are trying to achieve different things. So companies, for instance, will look to function in the markets very differently than individuals. So, again, we're just pushing these lows now. So not a million miles away from this bottom in gold. So I think if we touch these levels, it might be an opportunity to buy. Okay, there's a few things coming over the wires, but I don't think there's anything particularly of interest. So only a couple of ticks lower really for gold. It might be a buying opportunity. But again, we'll have to see how the market reacts when it hits them. A lot of the time, as I said, if markets are very, very strong trending, they can hit these levels and then instantly break through. And momentum carries on. So instead of bouncing these levels, the break levels. Top of the hour is business inventories. Yeah, I mean, business inventories could potentially, do something, but we'll have to see. I mean, the market, again, it's so tempting, isn't it? When the markets are kind of just drifting and meandering down. We've seen a bit more of a, downward move in the European stocks. The DAX is now down 25 points, 21 for the UK. The S&P is just basically, rebounded all that. Yeah, all eyes on the Fed. But, I mean, the Fed aren't going to come out and say anything, are they? They're not going to come out and say, yes, I'm sorry we've messed you around, people of the world, but we are actually going to start tapering in January, carry it on through March, and we're going to, stop paying out $10 billion a month because we can't sustain it. But, they're not going to do that, are they? So, unfortunately, our job as traders is really just to kind of, be interpreters, to be interpreters and to be able to read between the lines. And that's all we can really do, really, kind of read between the lines, figure out what they're trying to actually say, and then, get on board with that. So, anything else, guys? Yeah, that's absolutely right, Forrest Gale. Yeah, it's, unfortunately, it's just the game we play. I mean, if you choose to, trade the markets, we have to be aware of what's said. And it's all coded. It's all designed to be that way. Okay, Chuck saying the pound versus New Zealand dollar. Absolutely no idea why you'd want to look at that, but we'll go through it. The thing for me is, when you start trading things like the pound versus New Zealand dollar, you have to understand, why are you trading that? What are you going to get out of it? These things are fraught with danger. And if you're not trading, with the momentum and the majority of other people, then, you're likely to get caught out because it's people like banks that trade these kind of figures. It's not normal, average people. So you don't benefit from indicators working in the right way. You don't benefit from, the general market economies of scale. Where is it? Okay. So, well, yes, it's coming back up. So I guess it's going to hit 19858, and then that'll be the top of the Bollinger Band, and that's an area where the market can then retrace back down. And it's not really telling me a great deal. It's been particularly bullish. We've hit these tops, lots of wicks, so the market looks like it's ready to kind of fall back down, but we're finding support on the moving average quite nicely here. So, it generally looks like the market's going to go back higher, I would say. Again, it's in this kind of range here between 2.0074 and 1.9735. but it's failed to break higher, it's failed to break lower. So realistically, I guess if it breaks 1.9858, we're going to get back to 20074. Monthly, again, the end of a very bullish run. Again, the pound has massively weakened against the New Zealand dollar. Weekly, looking stronger. Daily, again, looks stronger. So I'd say probably short-term buy. But, yeah, I mean, if you look at the kind of D-mark, again, it's on the dailies, it's still looking quite aggressively low. We've rejected the overbought territory. We're getting towards the 50. So it looks like, for me, I'll be selling the tops because that's where the value is going to be. You're going to sell the tops and the market's going to come back down. But again, it's how you view it. I mean, you can either say that there's going to be short-term strength, so I'm going to buy that, or you can say, well, realistically, longer term, it looks like the market's still going to continue the bear run, so every high I'd sell. So I'd probably be a short-term buyer, as in the next couple of hours, but I'd be, a daily, weekly, monthly seller of the big highs because that's where the market looks to be overbought. Okay, so yeah, dollar yen would have to look at if you want to look at that one, Chris, because you can't trade the Chinese currency. Dollar yen. So dollar yen, again, very, very messy on the charts. So just a lot of data. But again, it looks like we're massively overbought. The market looks like it's going to be due a sell-off. So all this strength now, I'd expect, the dollar to get to 103, spot 180, 103, spot 400, and then I expect the market then to sell off. So hourly, really, again, 103, 180 would be, if we made a new high from this outside the Bollinger Band. But realistically, looks like the market's going to creep back down. I expect the dollar to certainly test the low of this candle at 102.659. So again, I mean, it's looking for a big reversal, isn't it? Again, with massive buy here on the kind of hourly chart. I mean, look at the D-mark, just go up, up, up. But now it's peaked again above this overbought territory. So you'd expect at some point now to sell off. So for me, as long as you don't make it a higher high from here, the value trade would be selling back to the moving average and selling back to 102.262 realistically. But again, I mean, you can tell the way the market's moving right now that what it's trying to do is know that everybody's short. And that's where you see stop grabbers. So everyone will have a stop here. So maybe the market pushes up, pushes to here, okay, where there's even more stops, and then it comes down. That's what you have to be able to overcome if you're a trader. Being able to have the right opinion longer term and to deal with the short-term volatility. So quite easily in this dollar, we could see this spike up and have a big long wick, trade outside the Bollinger Bands, for 20 minutes, and then do nothing for the next 3 hours but sell off. Okay, so remember, D-mark on the hour is anything above 70, is looking for a bearish reversal, and the same with the RSI. So we've rejected, again, we've seen a bit of divergence here. The RSI is buying, but the D-mark is really kind of telling us we should sell. So that's why we're seeing them complications right now in the markets. But, you've got to pick your choice, pick your decision. And if you trade purely hourly technically, if we close within the upper end of the Bollinger Band, you'd expect the market to move down and test the moving average. You've still got 25 ticks or so on the low side. And if we're going to get to the low end of the Bollinger Band, you've realistically got 55 ticks. But then, your risk you're going to have to take on board will be here. You're going to have to take 20 ticks of risk to make 25, 30 here, to make 60, 70 here, because that realistically is where the market can potentially push to before the real down move happens. So seeing the market's now reverse. Okay, the S&P has now gone from negative to positive. So very, very difficult trading conditions there. That is for sure. European markets, DAX and FTSE is still again, negative. So again, it just goes to show, that kind of negative divergence can happen. So it's not quite as simple, selling against the benchmarks per se. It's you have to kind of like make value and judgment calls. So again, euro dollar spiking around, but sorry, not euro dollar, the dollar versus the yen. So here, 102 spot 763. We're going to continue lower. That is a natural point the market's going to test. It's definitely going to test down here. Right, okay, Chris just saying that you can actually trade the Chinese currency on forex.com. Okay, offshore yuan trading. Okay, right. Well, I mean there we go. We learn something new every day. For me, if it's not standard and it's not traded by the majority of the world, I'm not interested. That's why I don't trade bitcoins. Bitcoins is just an excuse to get your arse handed to you, for want of a better phrase. You can make money once buying it, and you can lose your entire amount of money selling it. Okay? It's just gambling. Simple as that. I go with the probabilities. All these lines on my charts are because people have seen these, or the market participants have seen them as valid points of interest. So all I'm doing is repeating history. I'm not trying to reinvent the wheel. I've spent 10 years trading the markets, okay? And I've been consistently consistent. And that's the only way I can put it. I haven't, when my early days, the first time I pressed the button, I lost all the money I was backed to trade in a week. And they gave me more money and I lost all that. So, my initial baptism of fire in trading was one of losing money. But then after that, you learn, and then you learn to become consistent. And that took, it took months, it took years. And then once you are consistent, you can take the losses on the chin, and you can also take the profits as what you're trying to achieve as a trader. But then what you don't do, and what I don't do, is someone who writes software for trading, the chief market strategist of Intertrader.com, a 10-year veteran of trading. I could go on, but what I don't do is reinvent the wheel. I don't do that. So I don't trade Bitcoins because I don't really understand them. How can you trade a virtual currency? I don't trade Chinese currency because I'm not interested. I don't really trade Asian markets because I'm not really interested in them either. I don't really understand Chinese people. I don't understand communism. I don't understand a central government telling me what I can only have one kid or when to eat. Do you know what, China? Not interested. I live in the real world. I live in, well, not the real world. I live in Jersey. But doesn't mean I don't have to live in the real world. I don't have to be told what to do. I do whatever Steve Ruffley wants to do. So that means if I want to trade gold, I'll trade gold. If I want to trade the S&P, I'll trade the S&P. Because I understand people's greed. I understand the efficient way markets move. I don't understand a controlled economy like China. I don't understand how you can have a 100-year plan. And I don't want to trade your currency. So yes, you can go out there, and I'm sure lots of people have made lots and lots of money trading Bitcoins. Good for them. I'm sure people have made lots of money trading exotic pairs, like the Krona versus the Squibbly Dibbly. I don't trade them because I don't understand them. I stick to the things you hear about in the news every day. I stick to the DAX, the S&P, gold, maybe if you're lucky a bit of euro dollar. Because they're transparent. The Fed, when they do anything, they have to say things. There's no secret agenda. Okay, there might be a secret agenda, but there's no secrets in the market. The market is perfectly efficient at weeding out opportunities and bits of information. So if the Fed had something planned that was a secret, it would get out and you'd know about it. So there might be things being controlled behind the scenes, but the freedom of information with the internet, with everything else, means that everybody really, if they have a Twitter account, can find out anything about every market. So the more obscure you go in market, the less information you get, because the less people are interested. Markets work because of the self-fulfilling prophecy. So why do moving averages work? Okay? Why do they work? Because 9 out of 10 traders look at a moving average. That's why a moving average will work. If you're using a moving average, okay, on the New Zealand dollar versus the pound, who's looking at that? Probably central banks, probably big currency traders, but the average man on the street isn't. So that's what the initial liquidity and movement comes from, okay, by people trading off things they understand. So the more people that are looking at the things, the standard indicators like RSI, DMARC, Bollinger Bands, the more people are looking at them, the more the self-fulfilling prophecy will come into play, and the more they'll work. So the whole point is why I develop things and I write things and I do things, is because I'm trying to roll back. I speak to so many people, the like quants, and people that, I love it. People come to me. I've actually had a rocket scientist come to me and say, Steve, I've back-tested this system, I've wrote my own code, I've been to the moon and back. It's brilliant. All it does is make money. Can I have 50 grand? I'm like, whoa, hello, Mr. Rocket Scientist. If you've got a system that works so well, why do you need my 50 grand? Because you're not a trader. Traders are people that put the money where the mouth is. And that's why we're all in the same boat here. And I respect everybody that listens to my seminars. Gold hitting that level at 1226.37. It's ground down there, so I'm not going to buy it. Okay, if anything, I think that's going to break, and we're going to get down to 1764. Okay, it's just too slow grinding for me. I don't want to buy that. Okay, so I'm going to let it fall further down and maybe get to 1146 at the bottom of the Bollinger Band. So again, that's why we're all here. We all talk, don't we? We all talk about what we're going to do, but essentially, we're all traders. Okay, so we're all out there in the markets trading our own money and trading our own opinions. When you get people that have systems and have, great big ideas, that's great. But, if there were such big ideas, A, you wouldn't tell anybody, and B, you'd invest in yourself. You were so sure it was going to work. So that's why we all have to be careful as traders, because you don't want to get swept up and caught up in the nonsense. Like people on Facebook. My pet hate is people selling systems on Facebook. If it's such a good system, why would you sell it? Anybody can get, 4, 5, 10 grand together, borrow it off a bank. If it's guaranteed money, put that 10 grand you've borrowed into your system, and then go and live on a yacht. Why would you sell it for $49? It's just nonsense. So when it comes to InterTrader, my presentation on FX Street, all I can do is put my money where my mouth is. I've just told you gold was going to go down. I didn't sell it. I'm actually looking to buy it. But if for the 45 minutes I've dribbled on, you could have made 26 ticks out of gold just by selling it, like I said. And I told you it was going to go to 1226.37. So I'm not pretending. Just 'cause I haven't made money from it doesn't mean the things I say aren't still true. They are very true. And when I see good opportunities, I trade them. I put my money on. But like I said, I'm not going to get long gold here, even though I said I might want to, because it's ground down there. It hasn't acted in a way I would like to. I'd like to see lots of people taking my view and my opinion, and then actually waiting for it to push through and get long these lower levels. Because down from here, we've got nothing till 1180 spot 14, so we could quite easily dip through and push, these further bulls out of the market and then go back up. So depends how you want to trade it, guys. Again, I can only tell you my opinion and how I view the market. These lines are based on monthly points of interest, weekly points of interest, and daily points of interest. They're just what hourly candles make up in the longer term. That's it. Okay, Chris, you're dying for me to go through the dollar Swiss. Dollar Swiss is going to get hammered. Okay, so let's just quickly do that. We're running out of time. Dollar Swiss, okay, it's heading back up now, but I think long term, monthly, very messy. Weekly, we're going down. Simple as. Look how the support is acting on the weekly moving average and low end of the Bollinger Band. Dailies, again, we're going to see a bit of a rebound because in 1, 2, 3, 4, 5, 6, 7 selling days. I'd expect the dollar versus the Swiss to get back to 108. Just do a Fibonacci, okay? Start from the red days to that. Yeah, there we go. Perfect. Massive sell. We get back to the 50% or buy it up until that. 0.89666, sign of the devil. That's what's going to happen. Market's going to rebound up here, 88 ticks, then it's going to sell off and make lows from that. So that's the trade call. Buy the dollar up until the devil's number and then let it come back down. That's what's going to happen. Okay, big swing in the stocks again, from all that kind of positive, we're back negative in the S&P. Difficult trading, guys. So again, gold's holding on that 122637. The advice what my opinion of the dollar versus Swiss is, we make a little bit of up roads. Maybe we don't get as high as, the 666. Maybe we get as high as 301, and then the market comes back down. But short-term buy, long-term sell. Again, look at your D-mark, look at your RSI. We're dying for the market to blip back up, but long-term, I think it goes down. Okay, guys. Listen, always appreciate you, my regulars. Good to see Forex Gal. Chris, thanks for your comments today. Pretty much time for me. Anything else you want, guys, you can find me on Twitter at Steve Ruffley, steveintra.com. Loads of stuff coming up next year. I've just done my deal with InterTrader, so I'm going to be around all of 2014. So, again, if you want to watch me on different, different trading kind of, opportunities, do just come and find me on that. I'll be with FX Street, I guess, for the next year as well. That's part of the deal. So there'll be another webinar every week on FX Street for the next year. So I'm sure Maud, Vicky and the guys will be happy at that. So again, guys, the more people, the better. Tell your friends about these sessions. The more questions we get, the better it is, to get an idea of what the markets are doing. So it's our own selfish gain to have more people in these seminars because we'll get more of an idea what people are doing. Okay? Listen, thanks, guys. It's been an absolute pleasure, and I'll see you all very soon. Okay, guys, have a great afternoon. Take it easy.